Okay, let's work our way through chapter 4 and talk about risk and return. More of a statistical analysis, I guess. It's certainly going to be mathematical in nature, but people want to get paid more. People expect to get higher rates of returns. So what are the returns? Well, there are really two forms of returns. Income, you can receive interest and or dividend income. And there's capital gains or losses. So obviously if you make money, if the stock price rises, you have a capital gain. So the total return of an investment is based on this idea of the combined efforts between income types of revenues and capital gain revenues. How does this work? Well, again, if you spend $1,000 on two investments, investment A has some quarterly income, $80 for the year. The sell price at the end of the year is $1,100. Well, how much is income? The income comes from the dividends, or the cash received, $80. The capital gains, $100. So the total return for asset A is $1,080. And if you divide 1,080 into 1,000, essentially you made about an 18% rate of return. The asset B here, obviously, you only have $120 worth of income, but we also sustained a capital loss. So the total return is $80, and that obviously boils down to an 8% rate of return. So why is return so important? In a nutshell, basically, this is how you keep score, right? Historical performance is a foundation. Let's just know where the stock or where the asset has come from, right? It provides us a basis for what we think will happen in the future. Now, every investment that you ever hear about or have a broker talk to you about says that historical performance does not guarantee future performance. And that's absolutely true. There is no guarantee of what's going to happen in the future. Expected return is our perception. It's our desire for what we think is going to happen in the future. So this allows us then to determine what you're willing to pay for something, right? You want to get a certain rate of return. Based on what you think will happen in the future, you will have some idea of what you're willing to spend today. Return is affected by numbers and numbers and numbers of different types of concepts, right? There are internal characteristics, just the type of security, stocks versus bonds, the management of the company, how it finances its operations, its strategic plan. All of those things are internal and obviously affect the rate of return of the investment. There are also a number of external forces, the political environment, business, the economy in general, right? What about inflation? How's that going to affect price? So all of these things have an impact on the level of return for an investment. From your textbook, you can kind of see a little bit about different internationally how assets have performed. This goes from 1900 to 2014. And if you look at the United States stocks, about 9%, long-term bonds 5%, short-term bonds 3.8%. We have an inflation rate of about 2.9%. And certainly you can see countries that have higher returns and companies that have lower returns. I did this little excerpt from, I just did a basic calculation of returns. I used the S&P 500 composite total return, the Russell 3000 index, and the Wilshire 5000. These are all indexes that we've talked about and we may talk about even later. But I looked from 1979 to 2011, and I probably should do a little bit of an update to this. But the reason I chose 32 and a half years was essentially we're talking about us. We're talking about people getting out of college. They're roughly 22, 23 years old. They are, if you add 23 to 32 and a half, we're roughly in the ballpark of about 55 to 56, 57 years old. And these are the people, right, that are going to be thinking about retiring. So if you invested in these kinds of indexes, what rate of return would you expect to earn? And if you look here, the S&P 500 for these 32 and a half years is 11.1%. The Russell 3000 was 12.4, and the Wilshire was again around 11.19. So if you invest in the stock market on average and you give it enough time, you're going to have fairly decent rates of return. And in this case, from 1979 to 2011, roughly around 11% on average. So how do we deal with this? How can we talk about returns? How can we measure it? Well, the concept at work is something called the time value of money. The sooner you get a return, the better off you are. So a dollar received today is more than a dollar received sometime in the future. And the sooner you can get your money in the market and it's earning interest, the faster it's going to grow. Now we can do these calculations a number of ways. You can use financial calculators, you can use electronic spreadsheets, you can use formulas, there are tables in some textbooks. We're going to use a computer. I've provided a spreadsheet that you can utilize. I've provided videos so you can follow the spreadsheet and understand how to solve the problems throughout the course. And again, I've got a lot of work in there. I think it's very helpful, and it's a little bit takes some of the time consumption of understanding exactly the concepts. Right? It's a time saver for us. So what about the time value of money? We want to talk about an investment, right? Is an investment a good investment or bad investment? What makes one satisfactory? Well, a satisfactory investment is one that's going to earn money. So if the present value of what you're going to receive in the future equals the rate of return that you want today, that's a good investment. If the present value of the future exceeds what you want today, then that is a good investment. If it's less than that, then it is a bad investment. So in formula form, if the value of an asset, if the value that you place on an asset, if it's greater than or equal to what it costs you to buy the asset, the market value, you would be willing to purchase it. At the exact same time, if the internal rate of return, if what you expect to receive is more than what you want to receive, again, you would be willing to invest in that asset. So there's several measures that we can talk about, right? In order to make comparisons, we have to incorporate something called the time value of money. This looks at how cash comes in the future, at what time it comes, and then it equates that to something that we can relate to. And the thing that we can relate to is what a dollar is worth today. So let's think about some of these returns. The nominal rate of return is the rate of return that's expressed in current dollars. It doesn't take into account any effects of inflation and or time value of money. It is the stated interest rate or return on an investment. The real rate of return is the measure of purchasing power, right? It tells us whether or not you have actually made money when we take into account consideration of the inflation rate. So the real return is the nominal return minus the inflation rate. So let's continue on this. So what is this real rate of return? Right? The real rate of return is a very low, very basic base number, if you will. Typically, you think of it being something like a treasury bill rate. If you subtract out inflation, it's this, actually, let me go, it is really just the supply and demand of money. It's the intersection of the supply and demand of money. So if you think about the returns on an investment, how do you want to get this return? How much do you want? Well, investors, as it says here, are generally risk averse. We don't like risk, but we're willing to take risk as long as we get paid. So how do you want to get paid? I want this real rate of return, this very base rate. I also want to be able to beat inflation, but I also have to cover the risk premiums. And this becomes the tricky part, discovering and trying to determine what the risk premium is for an investment. So let's break this down into some pieces. The risk-free rate of return is a combination of the real rate and inflation. So how can we find this? We'll talk about this in a lot of detail a little bit later on, but the risk-free rate of return is essentially the rate of return that you can receive if you purchase a treasury security. The treasury security issued by the United States government is what we refer to as a proxy for the risk-free rate of return. So what is this total you want? You want to at least get what you would get on a risk-free basis, plus, again, whatever the risk premium is. So where's the risk premium come from? This is where we look at the characteristics of the company, right? The type of security, the maturity of the security. We want to look at the characteristics of the company, the industry. What are those things that take place inside this particular asset or company that add to the riskiness of the investment? One of the measures of return we can talk about is something called the holding period return. It looks at the rate of return over a specific time frame. Now, return can be looked at a couple of ways. Realized return is the income that you've received during the investment period. So this realized return is essentially taxable income. Paper return looks at the return that you have realized, but no sale has taken place, so there is, as of yet, there is no tax bill that's due. So the holding period return is a fairly simple formula. You look at the income you received during the period, add to that the capital gains, and divide that by the beginning investment value. So, again, how you calculate capital gains is obviously the ending investment value minus the beginning investment value. Now this formula is used for a 1 year or less investment. But what if it's more than 1 year? We need to maybe have an adjustment to annualize the rate of return for a specific time period. So let's look at 4 different investments here and see about their rates of returns, right? We're going to invest some money, right? And let's look at the stock, right? At the beginning of the year, we paid $2,000 for this stock. It has grown to $2,200. So the capital gain for this company is $200, and it paid $45 in dividends. So the total return was $245. So if you input that into a spreadsheet, we have a spreadsheet that's called the holding period return. If you look at that spreadsheet, you will see that there is the yellow boxes are all for data, and this is for a 1 year investment, and here we have the 12.25%. the bond asset here, right? We spent $1,000. It's now worth $970. So we had a capital loss, but we made $140 in interest income over the 1 year time frame. This return is 11%. Now, what would happen if it was a different time frame? What if we received all of this in 6 months? Well, we would need to change the investment time frame. The return would stay the same, but the annualized holding period return would change, because it shows how this would earn in an annual basis if we're not using annual data. So what are the advantages of using holding period returns? It's pretty easy to calculate, easy to understand, consider some income and growth. The challenge is the holding period returns itself doesn't consider the time value of money, right? That's the formula that we had in the textbook. Now the spreadsheet that we have, the annualized version, does take into account the time value of money. Now it's not perfectly accurate because the cash flows are assumed just to have occurred over the time frame, but it's a pretty close approximation of what you actually would earn in time value basis, adjusting for the differences in holding periods. So if we could change this, here's what he says. What if this happened over 3 years instead of 1 year? Well, here are the returns we calculated earlier. And of course, here are the holding period returns that are annualized. And if you kind of think about this, you earned over 3 years, you earned 12.25%. If you divide that by 3, roughly it's 4 point something, but it's going to be a little bit less because of the time value of money. So if you divided that by 3, you'd get an approximation, but it wouldn't be the right answer. The holding period return that's annualized then gives us, on average, how much did you earn per year on this investment. So now we can compare these two investments to understand which one's going to give us the higher rate of return over this time frame. So there you go. That's the part 1 of the return chapter.